Very briefly, just a couple follow-ups on a different topic. Dr. Hassett, you mentioned something that I've tried hard to explain to folks back home, and I do a lousy job of it, so I'm hoping you can help me, which you've mentioned something that I believe to be correct, which is that our current relatively high level of corporate tax rates encourage debt financing. Could you expound on that a little bit, please?
Sure, and I think this is something that we agree about, that because interest is a deductible expense for firms, and you know, a dividend is not, then there's a tax advantage for firms to borrow to finance a new enterprise as opposed to, you know, borrow or issue equity. And this tax advantage for debt can actually, depending on where interest rates and inflation are and so on, can get you a negative user cost for 100% debt financed investment, which, you know, maybe at times we want because we think that if investment is going too slow because people are too cautious or something. But the fact is that that a reduction in user cost is something that I almost always celebrate. But when the tax code encourages firms to be heavily debt laden, then if their plans fail a little bit, they have negative surprises on profits. Well, then all of a sudden the bondholders are lining up, throwing them into bankruptcy, and trying to get their cash out. So I think that this is one of the bigger distortions in the corporate tax. There are some arguments for it, especially tax lawyers tend to favor it, but I think economists generally view that as one of the larger problems with the corporate tax code.
Certainly, and I think everybody acknowledges the risks it exposes the businesses to the business cycle. Dr. Gravel, you mentioned in discussing one of the possible impacts of lowering the corporate tax rate of discouraging debt flows.
Right. That just shows that there's never an easy answer to anything, because it is true that our favoritism of debt causes all the things that Kevin mentioned. They can also have adverse effects for the flow of capital, because debt is far more substitutable across countries than equity. And there were a couple of Treasury researchers who looked at this effect of debt, and they concluded that if you lowered the corporate tax rate, you would actually reduce the flow of capital in the United States. So it makes it difficult to decide what to do about debt, because on the one hand it's causing this debt equity distortion, on the other hand it might be attracting capital from abroad. So,
and finally, and I know this is off the topic, but Dr. Hassett said something to me, said something in his testimony just a few minutes ago that's perhaps one of the most eye-opening things I've heard since I've been in Congress. And that's a tough list to make. And it's that he didn't prepare his own taxes, despite the fact that he is a PhD in tax economics. So, Dr. Gravel, I have to ask you the question: do you prepare your own taxes?
Yes, I do.
Good.
And without a bit of fear.
I was glad.
I would let her do mine. She's better organized.
Do you do Geithner's as well, or does he?
No. But on the other hand, Kevin's might be a little more complicated than mine, because I'm mostly a wage earner with some passive investments. So.
Thank you all both very much for coming today.
Thank you, Senator Lee.